Hello people, let's continue our revision series. Now we'll be revising ratio analysis topic. Okay, now in the chart book, I've only called out those ratios which are often tested in the examination. But let's do a thing. In ICA book itself, there is a summary of ratios. First, maybe we'll run through all the ratios once and then take up a few questions. Now again, from ratio is a good topic for examination. You'll not be asked ratio in a straightforward way. Like they will not say calculate current ratio usually in a straightforward way. They will again like leverages. Ratio will be find the missing figures wala question. Or they will give you some data, some ratio ka data using which we need to prepare P&L and balance sheet. That's examiner's ka favorite way of asking the questions relating to ratio topic. So again, easy, but it can go a little lengthy. And time. Again, the crux is here is the time. Able to identify what to start with. I'll take up a few questions there. I'll tell you certain things and points to keep in mind when you are solving the ratio questions. But before we get to that, first we'll have a quick run through of all the ratios. First, there are ratios are put into few categories. First is liquidity ratio. Under that, current ratio. Sir, how do you get current ratio? Current assets divided by current liability. Ideal current ratio is 2. Meaning if you have 1 rupee current liability, you should have 2 rupees worth of current assets. Similarly, quick ratio. Quick ratio ka another name liquid ratio, another name acid test ratio. How do you get quick ratio? Instead of current assets, you will take quick assets divided by current liability. And how do you get this quick asset? From current assets, reduce prepaid expense and reduce your closing stock. Because inventory and all you cannot sell quickly. It takes some time. Prepaid expense is really not an asset which you can sell. Hence, from current asset, remove these two parts. You will get the quick assets divided by current liability. See here, we are trying to test whether we have enough quick assets to settle the current liability. Ideal quick ratio is 1. Okay. Cash ratio. Cash ratio is given by the formula cash in hand plus cash at bank plus marketable securities divided by current liability. This ratio is trying to test whether we have enough cash balance using which we can settle current liability. Cash in hand, cash at bank is okay, no? Marketable securities means short-term investments. Okay, so whether these we have enough number or enough value to from which we can pay off current liabilities. That's what cash ratio is trying to test. Next, short-term investment. Less than 1 year. They will call it out clearly as marketable securities. You can directly take it. So you don't have to worry about the period. But short-term investments are those which are usually less than 1 year. Okay. Basic defense interval ratio. What is basic defense interval ratio is trying to calculate is if the sales of the company shuts down. If the sales of the company shuts down, for how long can the company survive? How long can the company survive? Like here, if you want to just check. Let's say company incurs 365 lakh rupees expense per annum to operate for the whole year. To run the business for whole year, how much it will cost? 365 lakh. So this is for whole year. For 1 day, how much is the expenditure? 365 lakh is the expenditure for 365 days. For 1 day, 1 lakh. Okay. Now people, basic defense interval ratio is given by the formula cash in hand plus cash at bank plus marketable security plus amount collected from debtor. 4 things. Cash in hand, cash at bank, short-term investments or marketable security plus your debtor balance. Let's say that put together comes to 25 lakh. It comes to how much? 25 lakh. Now you tell me to operate the business for 1 day, how much money you need? 1 lakh. How much money you have? 25 lakh. How many days can you run? 25 days. That's all is your basic defense interval ratio. So what's the formula then? Cash in hand, cash at bank, marketable security plus debtors divided by operating expense per day. How did you get this 25 days? 25 lakh divided by 1 lakh. No. What is this 1 lakh? Operating expense per day. If you take total operating expense and divide by the number of days, what are you going to get? Operating expense per day. That's all is a formula of a basic defense interval ratio. Okay. I'll tell you the ones which are popularly tested when we solve few questions. I'm planning to do like 4 to 5 questions from this chapter. That way you'll get to know which ratios are often tested. But for now, ignore that and let's have a run through of all the ratios. Net working capital, how do you get? Current asset minus current liability. This is the liquidity ratio. Next is capital structure ratio. First one is equity ratio. This ratio is trying to calculate of your total capital employed, how much money has come through equity. Of the total capital employed, how much money has come through equity. Tell the formula. Equity divided by capital employed. You can call it as equity or you can call it as shareholders equity. Another name, net worth. All are one and the same. Basically, how do you calculate this shareholders equity? Equity share capital plus reserves and surplus. Divided by what? Total capital employed. How do you get total capital employed? Equity share capital plus reserves and surplus plus preference share capital plus long-term debt. All the long-term source of finance ka addition. That is your capital employed. Or instead of capital employed, you can also call it as net assets. Another name, one and the same. Now, same lines by debt ratio. What do you think is debt ratio trying to calculate? Of your total capital employed, how much money has come through debt? So, formula will be debt divided by capital employed. Debt for this purpose, they say, is both long-term and short-term. In my opinion, they should take only long-term because capital employed means short-term source of finance or long-term? Long-term. Since denominator is long-term, numerator also should be long-term. That's my view, but we can't go against ICI. ICI is Zindabad. So they are taking long-term plus short-term. We'll go ahead with that. And next is debt to equity ratio. So debt to equity ratio, how do you calculate? Debt divided by equity. Debt divided by equity. Okay. Again, the formula will say total debt too, but when they apply this in the question, they only take the long-term debt that we have seen in the few RTPs, MTP question. But the formula will say total debt divided by total equity. But we usually take only long-term debt in the numerator divided by equity in the denominator for problem solving purpose. Okay, next is the debt to total asset ratio. Now, sir, if you want to buy assets, we need funds. Correct? The funds can come through equity shares or through preference shares or through debt. Debt to asset ratio is trying to calculate of the total assets, how much asset got funded through debts. How much asset got purchased with the help of debt. So, in the name only there is formula. Tell me, debt to total asset ratio is given by the formula. Total debt divided by total assets. Why we calculate this is, sir, taking debt is a risky, no? Taking debt is a risky. Why? If you don't have money to pay, then what will the debt people do? Come to the organization and sell off your assets. So if lot of assets are funded by debt means, and if you're not able to pay this debts off, what will happen to these assets? It will stay in your business or debt holders will start selling it. So that's the reason we will also watch out for this ratio as well. Next is capital gearing ratio. Of late, a lot of questions in RTP, MTP are being tested on capital gearing ratio. So in that sense, this could be a little important. Even in this RTP, you will see RTP or MTP capital gearing ratio is asked. Sir, gear, when you put a gear in car or bike, what will happen? When you put more, you obviously ride bike, you ride car. One of the things you ride, when you put higher gear, you will go slow or faster. Higher gear will imply higher pace or faster. Yes, no. Same goes for capital gearing ratio. Capital gearing ratio means using fixed cost instrument. What? Using fixed cost instrument to increase shareholders equity. To increase shareholders equity. You use fixed cost instrument to increase shareholders equity. First, the formula. You are using what for capital gearing ratio? Fixed cost instrument. Which source of finance on which source of finance you pay fixed cost? Debt and preference shares. Because preference dividend is fixed. Interest rate is also fixed. So what's your numerator? Preference share capital and long-term debt. And debt basically. Yes, sir. Divided by, why are you doing this? To increase shareholders equity. What is the formula for shareholders equity? Equity divided by reserve. Equity share capital plus reserves and surplus. Or you can call it as also net worth. Correct? If P&L balance is surplus, you will add. If P&L balance is loss means you will minus. That's common sense, no? So this is how you get the capital gearing ratio. Yes, sir, people. Fixed cost instrument in the numerator, equity in the denominator. Okay. What is a fixed cost instrument again? Preference share capital and your long-term debt divided by net worth or shareholders equity given by equity share capital plus reserves and surplus. So what is the meaning of capital gearing ratio? Using fixed cost instrument to increase the shareholders return. How is that? Is check here if you want to. Anyway, we told. Let's say first year sales was 10 lakh. Company is using debt on which how much interest is being paid? 1 lakh. Now, will this interest change every year or same every year? Same. First year, how much interest? 1 lakh. Let's assume this is the only income, this is the only expense. So, how much is your PAT, PBT, PAT or EISH? How much? I'm assuming tax rate is 0 for simplicity purpose. So, how much is your profit before tax? 9 lakh. Tax is 0. So, profit after tax also 9 lakh. Let's say preference shares is not there. So, EISH also is 9 lakh for simplicity. Okay, Naji? Next year, people, we saw bumper sale. From 10 lakh, sales became how much? 60 lakh. Will interest also, will there be a bumper jump or same amount? Interest rate is fixed. So that means how much is interest for second year? 1 lakh. Now what is EISH? 59 lakh. Why? Because from 9 lakh, EISH became 59 lakh. There is a big jump. Why? What is the main reason for that? Interest. Sales jumped. EISH also jumped. Fixed cost jumped as same. Same. That means when you use this fixed cost instrument, shareholders' return will be same, it will increase. That is what is capital gearing ratio. Using fixed cost instrument to increase the shareholders' return, because fixed cost will not change. Fixed cost will be same. In which source of finance you will pay fixed cost? Only on 2 sources of finance, which is debt to and preference share capital. So if you use that, means there is a good chance that shareholders' equity will increase. That's all capital gearing ratio is trying to calculate. You don't need to know the meaning, you just need to know how to calculate, for example. Next, proprietary ratio. Proprietary ratio means how much proprietary funds has been used to buy total assets. How much proprietary funds is used to buy total assets. So proprietary means what? Owner. Who are the owners of the business? Shareholder. Do we have only equity shareholder or also preference shareholder? And tell me, how do you calculate proprietary funds then? Equity share capital plus reserves and surplus plus preference share capital. If you do this, you will get proprietary funds. What is proprietary ratio trying to calculate? How much proprietary fund is used to buy total assets? That means how do you calculate proprietary ratio? Proprietary funds divided by total assets. Same like debt to total asset ratio. Proprietary ratio is given by proprietary funds divided by total assets. And proprietary fund is nothing but owners' funds. Equity shareholders funds plus preference shareholders funds. On this, I'll tell you this. There is one more equation to calculate this that I'll tell you in problem. For now, leave this out. Don't worry about this. And this is also fine. No? Interest coverage ratio. Interest coverage ratio, how do you get? EBIT divided by interest. EBIT divided by interest. Now, people, what earnings is available from which we can pay interest? EBIT ka full form is what? Earnings before interest and tax. From EBIT only you will pay interest. Yes. Hence interest coverage ratio is given by the formula EBIT divided by interest. Let's say EBIT is 10 lakh. Interest is 1 lakh. So when you calculated, how much you got? 10 or 10 times. This is a happy news or a sad news? Happy news or sad news? Happy news. Why? People, you have to pay how much interest? But how much profit is available? That means you can pay the interest once or 10 times. That means bank people are full jolly. Because they have given you a loan. Company has 10 lakh profit, but interest collectible is only 1 lakh. That means banker will be buku or happy. Happy because they expect this coverage ratio to be on the lower side or higher side. Better these coverage ratio, higher these coverage ratio, bank people and all will be comfortable. They will be comfortable giving you more and more loan to you. Similarly, preference dividend coverage ratio, you tell me. Is EBIT available for preference shareholders? Using what will you pay preference dividend? PAT, EAT, right? So that means instead of EBIT, you will substitute with earnings after tax or profit after tax divided by interest or preference dividend. PAT divided by preference dividend will give you preference dividend coverage ratio. Same way, tell me equity dividend coverage ratio. Is PAT available for equity shareholders or what is available? EISH. So that means the numerator will be EISH divided by equity dividend. EISH ka another name is net income. That's your equity dividend coverage ratio. Okay, next. This is fine. No? Next is efficiency ratio. I'll tell you one trick. These are all turnover ratio. First, let's read this. Total asset turnover ratio. Sir, when you look at the name, what is the formula that's coming into your mind? Total asset turnover ratio means what? Total asset turnover. No, by looking at the formula, what turnover means sales. It's saying total asset turnover ratio. By looking at the name, what formula is coming to your mind? asset divided by sales. Asset divided by sales. Do the ulta. Whenever you see turnover ratio, whenever you see turnover ratio, what will come in the numerator? Sales. Okay, I'd explain the logic of this. So you want me to tell it once again, or this is okay for you for exam? There's enough. Anyway, we don't need the logic for exam any which way, right? So one simple trick of turnover ratio is what? Sales in the numerator, other component in the denominator. So asset turnover ratio ka formula will be sales divided by total assets. Now people, first priority in the numerator is always sales. First priority in the numerator is always sales. If sales is missing, then as a next priority you will use COGS. If they give you both information, sales and COGS, first priority you will use what? Sales. Only if sales is missing, then you will go for COGS. Similarly, in denominator, first priority is average. First priority is average. Because sales, you will achieve it for 1 month or whole year. Hence, we need the whole year ka asset balance on an average. But to calculate average, we need opening balance as well as closing balance. If they don't give, then you will take the total assets. First preference, average in the denominator. If that is not available or calculatable, then we'll go for closing balance or total assets. Okay. Now, well, I'll just tell you the meaning of this. Suppose you got asset turnover ratio as 10. What does it mean? You got asset turnover ratio as 10. What is the meaning of this? If you get it as 10, anybody can tell me what is the meaning of this? Perfect. If asset turnover ratio is 10 means what is the meaning is, if you buy asset worth 1 rupee, from that asset how much revenue you will get? 10 rupees. From 1 rupee investment in asset, you are able to generate 10 rupees worth of revenue. That means you expect this number to be on the lower side or higher side? Higher side. The more higher these number, you are using the assets more efficiently. Hence, we are calling all this as what ratios? Efficiency ratios. Same way, build fixed asset turnover ratio for me. What's the formula? Sales divided by fixed asset. Numerator ka first priority, sales. Sales missing, COGS. Denominator ka first priority, average fixed asset. If that is missing, take the total fixed asset or fixed asset ka closing balance. Okay, Naji? Same way, fixed asset turnover ratio is 5. What does it mean? If you invest 1 rupee to buy a fixed asset, from that fixed asset, how much revenue you will get? 5 rupees. Higher these number, better you are using your, or more efficiently we are using our fixed assets. That's the meaning. Same way, capital turnover ratio. Chapandi. Sales divided by capital. You can call it as capital employed or you can also call it as net assets. Name is same. Okay, now if sales is not there, next priority, COGS. Working capital turnover ratio, same formula. Sales divided by working capital. Now, inventory turnover ratio. Inventory turnover ratio. So, what did we say? Sales divided by inventory. But hang on, you already studied. Inventory will, sales means it will include profit. Sales means it will include profit. Inventory you value it at selling price or cost price? Cost price. That means first priority for inventory turnover ratio should be sales or COGS. Here the ulta. First priority for inventory turnover ratio is COGS. COGS is missing, then you will go for sales. Clear? Because inventory is not valued at sales, it is valued at COGS. Goinda, got it. Denominator first priority, average stock. If that is not, if you cannot calculate that, then you will use closing stock. If inventory turnover ratio, if you get it as 15, what does it mean? You are able to sell your inventory 15 times a year. You are able to sell your inventory 15 times a year. Company wants to sell the inventories less times or more times. More and more we sell, more and more we will make money. So again, all this turnover ratio, we expect it to be on the higher side. Okay, debtor turnover ratio, same way construct. What is debtor turnover ratio? Sales. Sir, sales means total sales. Debtor comes from total sales or credit sales? Means a better number is what, sir? Credit sales divided by average debtors in the denominator. If average is missing, you will use closing balance of debtors. Correct, Aji? Everybody good? Okay, and do keep in mind this one. Once, I think, 1 or 2 questions we have on this. Sir, it is actually, this denominator is what? Read this line once again for me. What is it? Average accounts receivable. Accounts receivable andre debtors ledu. It's not debtors. Accounts receivable means debtors and bill receivable put together. Debtor and bill receivable both if you add, that we call it as what? Average accounts receivable. But in majority of the problem, bill receivable will not be there. Hence, we say accounts receivable and debtors are one and the same. But we have few questions in study material where bill receivable is given. Bill receivable is given. When bill receivable is given, accounts receivable is what, people? Accounts receivable is debtor plus bill receivable put together. Keep that in mind. Okay. All right. Similarly, debtors velocity or collection period. Debtors velocity or debtors collection period. That is simply given by the formula 12 divided by DTR. 12 divided by DTR. This is 12 months. If you want collection period in months, you will use what in numerator? 12. If you want collection period in days, you will use what in numerator? 365. If you want it in weeks, 52. So basically, we have used this in working capital management and many other questions as well. Okay. We had explained the logic also of this to you. Or maybe once again, if you want, I'll tell you here. Let's say DTR is 4. DTR is, what is DTR? Debtors turnover ratio. Debtor turnover ratio is 4. What does DTR 4 mean? Debtor turnover ratio 4 means, what does it mean? So from debtors, we collect the money. If debtor turnover ratio is 4 means, the meaning is company is able to collect from the debtor how many times a year? 4 times a year. 4 times a year. That means how much credit are we giving to the debtor? In a year, how many months are there? 12 months. 4 times if you are collecting from the debtor means roughly you are giving 3 months credit, no? Because 3 into 4 is how much? 12. And in a year, how many months are there? 12 months. Okay, so from the debtor turnover ratio, can't we find out debtor collection period? Yeah, if debtor turnover ratio is 4 means, looks like on an average collection period is 3 months. Now that you can calculate in one formula called debtors velocity or debtors collection period is given by the formula 12 divided by DTR you do. Here, how much is DTR? 4. 12 divided by 4 is how much? 3 months. Same thing you will get. Fine now people. So this we will use for examination. Correct. Same way, tell me payable turnover ratio. Now don't say sales. Sir, it's payable. Creditor and sales, any link or no link? No link. Sir, when you do ratio, right, you take one number in the numerator, another in the denominator. You can't take random numbers. There should be some connection. Numerator and denominator should be connected, not random variable. Is creditors and sales connected? Is creditor and sales connected? From creditor, you sell the goods or purchase the goods. So numerator should be sales or purchases. Total purchase or credit purchase. So that means payable turnover ratio is given by the formula annual credit purchase divided by average accounts payable. If that is not available means closing balance of accounts payable. And accounts payable means what? Creditor and bills payable put together. If bills payable is not there, and accounts payable and creditor will be same. Similarly, can you also calculate payable velocity or payable payment period? Same. What is that? 12 divided by PTR. PTR andra payable turnover ratio. So 12 divided by payable turnover ratio, if you do, you will get payable velocity or payable collection or credit period. Till you are comfortable. This and all you know. GP ratio is GP by sales into 100. Net profit ratio is net profit by sales into 100. Operating profit ratio is operating profit divided by sales into 100. Operating profit only we call it as EBIT. Okay, now some expense ratio. COGS ratio is given by the formula COGS by sales into 100. Operating expense ratio. Operating expense means selling and distribution overhead and administrative overheads put together. So that is your numerator. What is in the denominator? Sales into 100. This is important. Operating ratio, how do you get? It's not operating expense ratio. It is operating ratio. Sir, to run a business, you have to incur overheads also. You have to incur COGS also. You'll have to incur some direct expenditure also. You have to incur some indirect expense also. So operating ratio means COGS plus operating expense divided by sales into 100. Operating ratio is COGS plus operating expense divided by sales into 100. There is a small takeaway from this problem. If time permits, I'll take up the question. Otherwise, I'll tell you here only. In one of the problems, RTP or previous year or whatever, we had seen operating ratio was given as 85%. How much? 85%. Once again, operating ratio means COGS is also included. Operating expense is also included. Yes, sir. Once again, or okay. COGS and operatings put together. COGS plus operating expense put together is how much percentage of sales? 85%. Correct? No. So that means indirectly, if they give you operating ratio as 85%, means balance 15% is there. No, that is nothing but EBIT. That is nothing but EBIT. Sir, from sales, if you reduce COGS, what are you going to get? GP. From GP, if you reduce operating expense, you're going to get EBIT. These two put together becomes your operating ratio. These two put together becomes operating ratio. If this is 85% of sales, means EBIT obviously will be 15% of sales. Yes, sir. So this is another equation which you may have to use. If they give operating ratio as 85%, then EBIT will be 15% of sales. Using this, either you can find EBIT or you can find sales as a balancing figure. If time permits, I'll take one question on this. It is there. Okay, sir. Now let's see if operating ratio is given as 70%, then if operating ratio is given as 70%, then what will be EBIT? Balance is what? 30%. If operating ratio is 60%, EBIT will be 40%. Like that, use the balancing figure and get it. One of the things using this you can find as a balancing figure depending on the requirement of the question. Can I move on? COGS plus
operating expense.
Will
be
COS. Yeah, you can substitute. Financial expense ratio. How do you get financial expense? Means your interest. So interest you are expressing on sales. So given by interest divided by sales into 100. Now some profitability ratios are return. Now people, return on investment you can calculate on three things. Return on investment. One you already know. ROS. ROS as in return on capital employed. Or it could be ROE. Return on equity. Or it could be ROA. Return on assets. ROA. Okay. ROS ka formula, tell me people. EBIT divided by capital employed into 100. Return on equity ka? Is EBIT available for equity shareholders or what is available? Each. Divided by capital employed or equity? Equity. So that is your ROS and RO ka formula. Okay. Sometimes they will say calculate ROS on an after tax basis. Calculate ROS on a after tax basis. Sir, how do you get something on an after tax basis? Multiply 1 minus tax rate. Reconstruct that formula of ROS for me. EBIT into 1 minus tax rate divided by capital employed into 100. Our return on equity is already on after tax basis because you are taking each. Each you will get only after tax. So this you don't have to do 1 minus tax rate. Okay, na? Everybody fine? Now one more return is your return on assets. Now return on assets, there are two ways to calculate it. Depending on the information that we need on the question, we can use both the formula. One, return on assets is given by the formula PAT. Here, somewhere it is there. Here, PAT divided by average total assets. PAT by total assets. That is one. Or you can use EBIT into 1 minus tax rate divided by average total assets. Okay. You check what you need in the problem. If you need to find EBIT in the problem, you will use this formula. If you want to find PAT in the problem, you will use the other formula. Both are acceptable. You check what you need and accordingly use whatever formula is better suited for that particular question. Okay, EPS you already know. How do you get EPS? Each divided by number of equity shares. Dividend per share. How do you calculate this? Total dividend divided by number of equity shares. This is also fine. Dividend payout ratio. People, payout ratio is always expressed on EPS. Payout ratio always calculated on EPS. So dividend payout ratio ka formula you tell me. DPS divided by EPS in, that's if you want it in percentage, you multiply by 100. Price earning ratio again you know. MPS divided by EPS. Dividend yield. Sir, one quick trick is when they give you yield. Yield means market price. In whichever formula mein, in ratio mein, they say yield means market price will come in the denominator. So dividend yield ka formula you construct. DPS by MPS. Earning yield. EPS divided by MPS. Basically MPS will come in the denominator. Okay. I'll not go into too much of logic of all this. Now we just revise. Okay. So that's enough. We have discussed much more in the normal class on this. Market value book value ratio. Name only there is formula. Market value per share divided by book value per share. Q ratio. Q ratio, again, this is not something which is asked too many times. Only once it was asked. So again, this is something which just watch out. When something which is not asked, when it comes, it will come as a very straightforward question. They'll not give too much of pandaginda, and they'll ask for 2 marks, 3 marks. Because they know that majority of the students will be like, they will skip that. Okay, so just know it. It's easy only. Q ratio is nothing but total market value of equity and liability divided by replacement cost of asset. Now people, asset will never come forever. Will any asset in the business last forever, or you have to replace it? To replace an asset, we need money. That money you will raise it either as a debt or as a equity. So that is what this ratio is trying to calculate. Whether we have enough money in our equity and liability to replace our assets. Hence, Q ratio is given by the formula market value of equity and liability divided by replacement cost of asset. Suppose to replace the asset, we need 10 lakh and our market value of equity and liability is also 10 lakh. So that means how much is Q ratio? 1. So what is in an analysis of this ratio is, if Q ratio is exactly 1, if Q ratio is exactly 1, share is fairly priced. Share is fairly priced. If Q ratio is greater than 1, then shares are overvalued. If Q ratio is lesser than 1, shares are undervalued. Maybe they may ask you the analysis also. It's there in ICA study book. If you want to write, you can write this down quickly there somewhere in a notebook if you want to copy. It's there in the study material also. It's not there in the summary book. It's given in the normal section of things. But still, if you want to copy, yes, free to do so. Okay, na Sarji, move on. Q ratio is 1 means stock is fairly priced. Greater than 1, stock is overvalued. Lesser than 1, stock is undervalued. Okay, sir. Next, DuPont model. What? DuPont model. Normally we eat like this, no? DuPont model is like this. That's all. Finding the same way through a different route. That is DuPont model. Now people tell me what is ROSE. Full form, formula tell me. EBIT by capital employed. DuPont sir doesn't like that. Nah, maza, no maza. Maja illa. As per DuPont model, how do you get ROSE? You take operating profit margin. You take what? Operating profit margin. Multiply capital turnover ratio. You take what? Operating profit margin and multiply capital turnover ratio. Check. How do you get operating profit? EBIT by sales. How do you get capital turnover? Sales by capital employed. This sales, that sales are cut to what remains? EBIT by capital employed. What is ROSE ka normal formula? EBIT by capital employed. Sir doesn't like this. This way. Okay, now. Sir, that means in exam we will cut this. No. In exam they will not give you this data. They will directly say operating profit and they will say capital turnover. So you should know that by multiplying these two you will get ROSE as per DuPont model. Fine, So this is one. Next, DuPont model did not stop there. They said, why stop it at ROSE? I will also give you one more formula for ROE, return on equity. For equity shareholder, operating profit is available or net profit is available. So instead of operating profit, substitute with net profit. Instead of capital turnover ratio, substitute with asset turnover ratio and multiply by equity multiplier. Net profit margin, then asset turnover ratio multiplied by equity multiplier. These three, if you multiply, you will get the return on equity. By the way, by doing this also, you will get the same answer. Because net profit margin is, how do you calculate net profit margin? Net profit divided by sales. How do you get asset turnover ratio? Sales divided by total asset. This sales cut. What is the formula for return on equity? Tell me, what is the normal formula for return on equity? Each divided by equity. Correct, huh? So ultimately we should get this. Okay, so far what have you got? Net profit margin by sales divided by total assets. This cut. Right? But total asset is still there. Do we have total assets here? No, that means how do you get equity multiplier? Tell me. This total asset should be cut. It's there in the numerator. How to cut it? Bring in the numerator. So equity multiplier will be, how do you calculate? Total assets divided by what do you need in the denominator? Equity. Now tell me, this sale cut, this sale cut, this asset cut, cut. What remains? Net profit by equity. Usually preference shares will not be there. When preference shares are not there, net profit or PAT only will become ish. So everything is same only. You will get the same thing, but in a different way. And in question, they will not give you all this data. They will give you what data? They will give you these three data. So, but by multiplying, you should be able to figure out that you will get ROE. Again, all this will be one marker, straightforward question. So just multiply and get the answer. Done, people. With this, all this ratio, meaning and its calculations, we are done. Tata bye bye. Or you want to do some problems? We'll do some problems. Pakka na. Ajjo, I thought you will say no. I actually made up my mind. I'll pack and leave. Caught hold of me. Fine. Ninth question. I have taken some questions which I feel covers some good area with respect to the ratio. How much? I'll also come, madam. He's going, it seems. We'll all go. Like, yes, sir, we'll go, sir. Sir. What is there in the ratio, sir? Boring. Okay, question number. And this is a question number 9 in our notebook. It's again a study material question. Let's see what we can learn from this question. Following financial ratios of PQR is available for year ended 31st March 21. Now, people, ratio question will be quite lengthy. They will give you balance sheet or they will give you a dump of data. Always, and this is not just for ratio topic, whenever the question is lengthy, first have a quick look at the requirement. What are they asking? You need to prepare summarized P&L and also balance sheet. So they have given certain ratio information using which you have to prepare P&L and balance sheet. Okay, sir. Now the best way according to me to solve ratio question is, they ask P&L and balance sheet. One page P&L format. Another page balance sheet format. From third page onwards, working out. Read the data. If it directly comes in P&L means push it to P&L. If it directly comes in balance sheet means push it. If it is not coming anywhere means let's keep it on hold and then figure it out. Okay, sir. That way you don't have to read the question again and again. Okay. That's one approach. Have the format. Another one you should keep in mind in ratio problem is, normally people when you read this data, see now you don't even feel like reading this data, correct? No. GP 15% of sales, net profit 8% of sales, this is some works cost to this, they've given. Okay, they've given a dump of data, but any number is there or everything is connection? One is connected to the other, but nothing has a value. So when they give you a question like this, check. There will be one component which will be linked multiple times, at least 2 or more times they will link it. That's your clue. Okay. Now here check, they have given value of the, first of all, this is a data for which year? Year ended 31st March 2021. Now they told fixed asset as on 31st March 2020. Current year, last year. How much? 26 lakh. Anywhere they have given depreciation data? Depreciation rate? No. That means what is the assumption? Last year if it was 26 lakh means current year also 26 lakh. No information to find, depreciation. 1. Or fixed asset could be land also. On land we don't depreciate. So we don't know. So lack of information. Last year 26 means current year also 26. So one value finally we know. How much is that? 26 lakh. First to push this to balance sheet. Over. Okay. As and when I see, maybe I'll tick off. And this is over. Next. Now people, if they've given one value, usually they will connect. Fixed asset, they will link it. Check, is fixed asset linked with anything? Here I don't see anything. I think I got the point. Fixed asset they've linked with sales. Fixed asset they've linked with current assets. And then they've given current ratio. How do you get current ratio? Current asset by current liability. So current asset has got linked with current liability. Current liability has got linked with long-term loan. That means I have figured all 3-4 components I have figured out. First working note, what? To find sales. they told fixed asset divided by sale is 1:3. So use that as a first working note. Fixed asset by sale is 1:3. Fixed asset value they have given. So you can find sales as 78 lakh. Yes, sir. Immediately push sales to P&L. Sales in P&L mein sales will come for 78 lakh. Sorted out. Okay, next. What have they linked the next to? They linked fixed asset with current assets. So fixed asset divided by current asset, if you do, that is in the ratio of 13:11. So next, use this basis. Fixed asset by current asset, if you use fixed asset, you already know 26 lakh. Using this, you'll be able to find current assets. How much? 22 lakh. Any problem? Current asset, where it will come? P&L or balance sheet? Current asset, P&L or balance sheet? Balance sheet. Now one more point. This will apply in every problem. Whenever they ask balance sheet, in current assets, you'll have breakup. What are the components of current assets? Closing stock, debtor, cash, all this will be there. What is the total current assets you got? 22 lakh. Now what you do is, components like closing stock, debtors, you show it in the inner column. You show it in the inner column. Total, you show it in the outer column. Don't forget this. Why? I'll tell you in a bit. Now, did you get total current assets? How much? 22 lakh. Where will the total current assets come? Balance sheet. Inner column or outer column? Outer column. Done now. And that means, people, the moment you see this, one thing should click. Fixed asset 26 lakh. Current asset 22 lakh. Fixed asset plus current asset is what? Total assets, how much? 48 lakh. Balance sheet always matches for us. Even when it didn't match also, it matches for us. Somehow we used to write something and match it. Yes or no? So this side 48 means equity liability side is also 48. Don't forget that. Okay, in balance sheet when you're doing, two components you should not forget to. One, showing it in the components in the inner column, total on the outer side. And the moment you get one side total, also update another side total. This will be your hidden adjustment for to find something there. Okay, now this is done. Next, anything else they have linked down? Yeah, current ratio they told us 2:1. What is current ratio ka formula? Current asset divided by current liability. Current asset you already know. Current ratio also you know. With this we can find what? Current liability. How much is this? 11 lakh. You will show this in the outer column. So current liability how much? 11 lakh. In balance sheet current liability 11 lakh. Easy. Okay. Next, anything else they have linked? Yeah, current liability they have linked it with long-term loans. Long-term loan divided by current liability if you do, you will get 2:1. So long-term loan divided by current liability you do, you will get 2. So therefore long-term loan will be 2 times of current liability. Current liability is 11 lakh. 11 lakh into 2 is how much? 22 lakhs. Long-term loan where it will come? Long-term loan where it will come? Balance sheet. Which side? Liability side. Long-term loan 22 lakhs. Yes, sir ji. Paka. Sometimes they will say it is 10% long-term loan. It is 10%. 10% means interest. They also ask P&L. So don't forget to show interest in P&L. Here percentage given or missing? Missing. That means can we calculate interest or not possible? If it is, sir, in ratio problem, no, to the extent you solve. And don't put to follow schedule 3 format along. Accounts. So. Here everywhere normal. This balance sheet format and normal P&L format. Schedule 3 format, venda. Beda. Yes. What much? Okay, done. Now here, is this interest rate there or not there? Not there. So can we find out interest or not possible? Not possible. So that means this information from here to here, everything we have captured. Correct? Yes, people. We read the question. Anywhere we see preference share capital. Preference share capital anywhere we saw? No. Take a calculator. What is the total equity and liability side? 48. Now tell me, sir, or maybe tell me once again, what and all can come on the equity liability side? Equity share capital plus reserves in surplus plus long-term debt plus preference share capital plus current liability. Yes, sir. Current liability we have found. Preference share capital not given. So 0. Long-term loan we already found. Correct? No. That means you will be able to find these two. Sir, you can write equity share capital and reserves in surplus, or you can simply call it as net worth. Yes. How much is net worth balancing for you? Calculate for me. 48 lakh minus 11 lakh minus 22 lakh. How much? 15 lakh. Got it? That's the reason I said always have the total. Because one of the component you can get it as a balancing figure. Easy. Equity and reserves in surplus put together, if you do, you should get 15 lakh. That only we call it as net worth, correct? Yes, no, people? And that's what I've done here. Where is it? Total equity and liability side is 48 lakh. What and all can come in the equity liability side? Equity, long-term debt, current liability. I have not written preference share capital because it is not there. So therefore, what is equity or net worth like you told? 15 lakh. So far good. Now they have given one more information. Check in the question. What did they say? Capital to reserves and surplus is in the ratio of 1:4. Capital and reserves, both if you add only, you will get what? Net worth. Or you can call it as equity. Yes, no? Equity is in what ratio? 1:4. And equity ka value you just now got. How much? 15 lakh. Therefore, what is equity, share capital, reserves and surplus? You just have to distribute in 1:4 ratio. 15 lakh you distribute in 1:4 ratio, people. Capital is 3 lakh, reserves and surplus is 12. Got it, huh? Yes? Right. They're in the other mood only. Okay. Capital 3 lakh, reserves and surplus 12 lakh. So we have, in fact, balance sheet we have finished. Except to individual component of current assets we have found or not yet? Not yet. That we will figure out. But without that, total level we have completed. Okay, now let's see. From here to here, we have used all the information. Now they have given first information. Let's see we can use that. How much is GP, people? 15% of sales. Sales you already know. Yeah, sales we have already found. Okay, first let's review this, or else maybe 1 second, hang on. Maybe we'll read all this data and then we will solve each component. Sir, sales you already know, because fixed asset was linked with sales. Sales we have already found. From sales you can find what? GP. Have they given net profit? Net profit is 8% of sales. You can find net profit. Sir, works cost is nothing but your COGS. It's nothing but your COGS. Sir, from sales if you reduce GP, what are you going to get? From sales if you reduce GP, you're going to get cost of goods sold. If sales is 100, if GP is 15%, if GP is 15% of what? Sales. What is GP amount? 100 ka 15%. How much is that? 15. Therefore, what will be your COGS, people? 85. Correct? Huh? Or can I say COGS is 85% of sales? If GP is 15% of sales, means COGS will be balance, which is 85% of sales. Got it? Huh? And do you know sales? Yeah. If you know sales, you can also find out COGS. COGS is nothing but your works cost. This works cost, they have linked it with 3 component. Check. Raw material consumed is 20% of COGS. Direct wages is again 10% of COGS. Stock of finished goods is 6% of COGS. That means many things are linked with COGS. Correct now, people? So we can finish off many things. Can we quickly do it? Okay. I'll these 2 information, I'll read it in a bit. Now first, what is that they told? GP. GP is how much percentage of sale? 15% of sales. How much is sales, people? 78 lakh. 78 lakh of 15% is how much? 11 lakh 70,000. How much is? So if GP is 15% of sales, I can't keep up with them. They're shouting more than me. Correct da? Correct da? Huh? Interesting. Okay. Sir, if GP is 15% of sales, COGS will be 85% of sales. So calculate COGS. And net profit is also given. How much is net profit? 8% of sales. So you found all this. GP will come in P&L account or trading account? GP da. GP da. Trading account. 11 lakh 70,000. Go ahead and put Chukki. 11 lakh 70,000. Net profit. How much is net profit? 6 lakh 24,000. Net profit, you put it in your P&L account. Okay, na ji? Then few things they linked again with works cost. What are those things they linked with works cost? What and all they linked? Once again, if you want, I'll show you. Raw material consumed is how much? 20% of works cost. Works cost is nothing but your COGS. So 20% of COGS is raw material consumed, 10% of COGS is wages, and 6% of COGS is stock of finished goods. These three they have linked. That's what we have found here. Raw material is 20% of works cost. Works cost is COGS. How much we got as COGS? 66 lakh 30,000. 66 lakh 30,000 ka 20% to 10% to 6% to these three numbers. Any problem? No. Tell me where all this information will go. Raw material consumed, where it will go? P&L or trading? How do you get raw material consumed in equation? Can you tell me? How do you get raw material consumed? Opening stock of raw material plus purchase of raw material minus closing stock. Yes, sir. Means when you show raw material consumed directly, will these three components come in trading account or it will not come? Because considering this only, you will get raw material consumed. So again, you don't show opening stock of raw material and closing stock of raw material in trading account. So what does raw material consume? 1326. Push this. Raw material consumed 13,26,000. I have told how we have got that. Okay, next wages. How much people? 6,63,000. Direct wages. So trading up P&L. Trading account 6,63,000 direct wages in trading account. Then we got what? Stock of finished goods. Raw material. Stock of finished goods. What stock is this? When they say stock, it is closing stock. How much closing stock? 3,97,800. Closing stock will only come in trading account or also balance sheet? In balance sheet, where? Under current assets. Current asset total we have already captured. Under that first component we got, that is closing stock of finished goods. How much? 3,97,800. Raw material we have not yet identified. We'll come to that. Finished goods is 397,800. Okay, Naji. Only here or also trading account? In trading account, write closing stock of finished goods. WIP not given, just for reference I've written. Okay, then what else we found? This is also done. Then closing stock of raw material, they told something. Check what is that, people? Stock of raw material is 3 months of usage. Usage means raw material you will sell or consume. Usage here refers to consumption. 3 months of annual consumption, you will keep it as a raw material ka stock on an average. Once more, stock of raw material is how much? 3 months usage. Usage means COGS. How much ever you are consuming in a year, 3 months of that you will keep it on an average as closing stock. Now people tell me, how much raw material have you consumed whole year? Raw material consumed for the whole year is 13,26,000. This 13,26,000 is for 1 month. This 13,26,000 is for 1 month or 12 months? 12 months. Eh? Oh, in 12 months stock you are keeping or only 3 months stock? This 13,26,000 represents 12 months. How much for 3 months? Calculate this for me. 3,31,500. What is that? Closing stock of raw material. Will this come in trading account or it will not? It will not come. Why? Because you have already shown a raw material consumed. How do you calculate raw material consumed? Opening stock of raw material, purchase of raw material minus closing stock of raw material. Again, if you show closing stock of raw material, it will be double consideration. So it will not come. In where? It will not come in trading account, but it will come in balance sheet. Closing stock also comes in balance sheet, no? So what is closing stock of raw material you got? 3,31,500. So that is your second current asset component, closing stock of raw material we got. So we are pushed. Yes, sir ji. Okay, next what information they gave? Debtors collection period is 60 days. Now it's very simple. Tell me how much is sales? Sales is how much? 78 lakh. Sir, this 78 lakh is the value for 1 day or whole year? Whole year. Some problems may they take 365 days or 360 days. Anywhere here they mentioned no. If they don't mention, then we'll take the normal. 1 year is how many days? Sir, this 78 lakh is a sales for 1 day or whole year? Whole year. Whole year means how many days? 365. 365 days credit are you giving to your debtor or only 60 days? For 60 days, how much is the value? For 365. Sir, debtors is linked to credit sale, no sir. This 78 lakh is total sale, sir. This is wrong, sir. Yeah, correct. But have they told anywhere cash sale? If they don't give any cash sale information, assumption is what? Total sales, credit sale, both are same. Meaning all the sales are made on a credit basis. So for 365 days, value is 78 lakh, but collection period is only how much? For 60 days, how much value? Pro rate X is equal to what here? 78 lakh into 60 divided by 365. How much, pa? That is nothing but your debtors. How much? 12 lakh 81,000, 82,192. Fine now. Debtor will come in trading P&L or balance sheet. Any problem in this calculation, everybody, or okay? Or if you don't like this approach, I can show you another one. You want another one? This is easy. I would suggest this to do an exam. If you want, we can do another one. What is that? No, okay, sir. This only better, sir. Then. How do you calculate debtor turnover ratio? Debtor turnover ratio. Debtor turnover ratio. Debtor's collection period. Sales or first 1 minute. Hang on. Okay. I think what I have to do is, okay, I think if you want to use formula method, I have to find out one more. Wait. Now people, how much is, now do you know debtor collection period? Yeah. Using debtor collection period, you can find debtor turnover ratio. Yes, no? What is that? 1 divided by debtor's velocity you can do. Agreed, no? How did you find out debtor velocity? How did you find debtor's velocity? Or okay, we'll use that formula only. Wait, bad. You're looking at me differently. Okay. Now if you want to, what, they're not going only here. Sir, if you want to calculate debtor's velocity, what is the formula? 12 divided by debtor's turnover ratio. Yes, sir. Debtor's velocity means collection period. Here collection period is missing or given. How much? 60 days. Sir, it is in days means I have to use 12 in the numerator or 365. 365. 365 divided by DTR. Therefore, DTR will be what? 365 divided by 60. Correct now? That is what I told in the formula. Debtor's turnover ratio is 12 divided by DTR. We leave. Tell how much is this? 6.083. Okay, now. Then what is another formula to calculate debtor turnover ratio? Sale. Here anyway, sales and credit sales both are same. Divided by average accounts receivable. Average number is not there. So we will take accounts receivable. Here bill receivable there or not there? And bill receivable are not there. Debtor and account receivable will be same. How much is debtor turnover ratio? 6.083. What is sales? 78 lakh. Divided by debtors. Now to calculate how much is this? You'll get round off errors, obviously. That's acceptable. Same number. Now you tell me, you want to do whole this drama, na? All of this you want to solve. Oh, don't you think this is easy? It's easy. Okay. If you want to use actual ratio formula, this one. Lengthy. So it's pretty common sense also. Sales they have given. How much? 78 lakh. 78 lakh is a number for 1 day or 365 days. What is the collection period? For 60 days, what is the value? Unproportionate. So this is much easier. I would suggest this for examination. If you don't like it, you can use actual ratio formula and get it. There will be a slight round off error because this is not 6.083. We stopped at 3 decimal. There are more. So some round off error will come. Done, Sarji? Okay, this is also done. Next, what else remains? Anything else we have not used or everything we used? Everything we have used. Yes. Now, first balance sheet we'll figure out. Debtors we got 12 lakh. How much? 82, 192. Now, why did I ask you to have total current assets in the outer column and components in the inner column is? Add this for me. Whatever value so far you have got, add this for me. Only this. Add only this circle number. This number. 3,31,500 plus 3,97,800 plus 12,82,192. These three numbers. You're getting 20 lakh something, but total current asset is 20 lakh or 22 lakh. It is not matching. There is a balancing figure. Have they given any information or no info? Now you will never be able to tally balance sheet. If you write this in the outer column, you will keep saying 1 lakh balance sheet not matching. Sir, it is summarized balance sheet. So whatever is not matching, you will get it as a balancing figure. What is that? That is outer column, inner column will help you to figure out this. Okay, now so what is that component? What is the difference? 1,88,500. So stock has come, debtor has come. What is one main component which has not come? Maybe prepaid expense, maybe cash. prepaid expense mandatory? No. I think among prepaid expense, cash, which is a better one? Cash. Or if you don't want to give names, simply you can write other current assets arrived as a balancing figure. That way I would always suggest have the total in the outer column, components in the inner column. So you will be able to get one component as a balancing figure and balance sheet will match out. Okay, na sir? Balance sheet over. What about trading P&L? Not yet. Unfortunately, not yet. Now, sales, I think we have already ticked, gone. Now, everything we have ticked. GP also we know. But is total matching or still there is balancing figure? Still there is balancing figure. Now, tell me what and all have you considered? Raw material consumed we considered. Direct wages we considered. So, the moment raw material is there, we are a trader or manufacturer? Manufacturer will only have material cost, labor cost or also production overheads. Means you will get manufacturing overhead as a balancing figure. These are summarized P&L. One or two components you will get it as a balancing figure. So, manufacturing overhead not given, you will get it as a balancing figure. Yes, sir, Sarji? Yes. First thing you will write in P&L is by GP brought down. And net profit also you know. Matching there is balancing figure. What will come in your P&L? Selling and administrative overhead. Administrative overhead, selling and distribution overhead. That only we call it as operating expense. Arrived as a balancing figure. That's all. This problem over. Done, Aji. It will be lengthy, but you need to identify what is tied out. That don't forget. So the takeaway of this question, if you have to summarize. One, current asset ka total, you put it on the outer column of balance sheet. Same goes for current liability. Current liability, usually they will not give breakup. So it really doesn't matter. This outer column, inner column makes a lot of sense for current assets. That is one. Another one, the moment you get fixed asset total, current asset total, get the balance sheet asset side total. Same thing will become liability side ka total as well. Update the totals immediately. So if you're getting stuck, always think on the total. That could be one of the clue. Here, how did we get net worth? Would they give? No, we got net worth as a balancing figure by looking at the total. So hence have the total in mind. Okay. Then check one component will be linked multiple times. At least 2 times they will link. Start with that. So that way you will be able to proceed the question faster. Here what was linked? Fixed asset was linked. So we started with that and accordingly, yeah, we solved majority of the things. Done, people. And that's pretty much about this problem. Can we move on to the next question? One is only enough. Our mind want to say yes, so, but heart is saying few more. Yeah, no. Tummy is saying, bido, we'll go home. Yeah, let's go and have fun. Okay. Can we do 4 questions I had kept? 1 over. After this, I will ask. If you say stop means stop only. Continue means continue only. Whatever you say. Then, continue, sir. Okay, sir. Fine. Ganapati Limited has the following ratio. Sir, these are all some class question. I had marked it as LDR. Okay, last day revision questions. So I have big list of LDR. So that's okay. Leave that. Let's not worry about that. Sales, how much? LDR means last day revision. Okay. Sales, how much? 60 lakh. Return on net worth. 1 second, people. Return on net worth ka formula, tell me. Return net worth means equity. That means return on net worth is nothing but return on equity. What is the formula for this? Each divided by equity is equal to 25%. Yes, sir. Maybe we can use this somewhere. Let's see. Income tax rate 50%. Fair enough. Share capital and reserves is in the ratio 7:3. Last problem 1:3, I think. Here it is 7:3. Current ratio they have given. Check this. Sales they have given. No? Now they told net profit to sale is 6.25. Net profit means always what, people? PAT. So that means basically if you do PAT divided by sales, you will get 6.25%. Sales you already know. This answer you already know. From this what we can find? PAT. Okay now. And preference shares is not there. That means PAT and each both will be same. That means we can use this equation to find net worth. From net worth, we can find share capital and reserves and surplus. Automatically linked. Understanding? Am I speaking to myself? Inventory turnover ratio based on COGS is 12. And COGS is also given in the question to be 18. That means easily you can find. Inventory turnover ratio ka formula. COGS divided by first priority average stock. If you cannot find average stock, closing stock. Okay, let's see if we can find or not average stock or not. Interest on debentures they have given how much? 60,000. This they have only given. Receivables they have given, payable they have given. Awesome. You need to calculate operating expense. We need to calculate operating expense. Also, you need to prepare balance sheet in this format. They have only given. But good thing is they have only filled out few components of balance sheet. What are those? Receivable, how much given? 2 lakhs. Now we will not write in the outer column. We will have the inner column approach. Okay, next to payable is how much? 2 lakh. Okay, people, one more clue is 15% debentures. It is 15% debentures. You know the interest amount. You know the interest rate. Can't you find out debenture value? How do you find? Interest amount divided by interest rate. 60,000 divided by 15%. How much? 4 lakh. This also you got. Correct, Aji. Anything else they have given? No, this we have figured out. Next, I think normal. No. Once again, if you want, I'll tell you. They have given net profit to sales how much? 6.25. Is sales missing or given? So first working note is this. From this, what we can find out? Tell me. Net profit. Net profit ka another name. PAT. So check the working note number 1 what we have done. PAT. How much is net profit? 6.25% of sales. So therefore, net profit is 60 lakh ka 6.25%, which is 3 lakh 75,000. Sorted. Okay. Next, they gave return on equity. They have given return on net worth or equity how much? 25%. Net worth is nothing but equity. What is return on equity ka formula? What is return on equity ka formula? E divided by equity is equal to 25%. Sir, there is no preference dividend. We saw the balance sheet. Are you able to see any preference share capital? No. If there is no preference share capital, there is no preference dividend. If there is no preference dividend, PAT and ESH will be same. What is PAT? 3 lakh 75,000. Same thing will become ESH. Equity we don't know. This is 25%. So solve and you will get equity how much? 15 lakh. Okay, na sir. How do you get equity? What put together is equity? Equity, share capital and reserves in surplus. And they have given the ratio. Share capital and reserves in surplus is in what ratio? Share capital and reserves in surplus is in the ratio of 7:3. Total net worth is 15 lakh. Equity and reserves in surplus is in this ratio. Means how do you find share capital? 15 lakh you have to distribute in this ratio. 7:3 ratio. You will get share capital and reserves in surplus. Fill it up. Share capital 10.5, reserves in surplus 4.5. 10.5 and 4.5. That means you have the balance sheet total. How much is that? 11 lakh, 15 lakh, 19, 21 lakh. If this is 21 lakh, that side also 21 lakh. Correct, Aji? Now, if you're getting stuck, you check which information you have not yet used. That will be the clue. So far, what have you used? Sales we used. Return on net worth we used. Income tax not yet. Share capital, reserves in surplus used. Current ratio. Tell me the formula for current ratio. Current asset divided by current liability. Total current asset we don't know or not yet. What about current liability? Only one is there in current liability, which is what? Current liability, you know. Current ratio, you know. With this we can find current assets. That's your next clue. Use that and find out this. How much? 4 lakh. Where will you write? Inner column or outer column? Current assets total. Total current assets, you will push it in the outer column. 4 lakh. Yes, Aji. Correct, Aji. Next, what information we can use? This also used. Net profit to sales pending used. Used. Next, inventory turnover ratio. Now, anywhere in the problem they gave opening stock. Because to find average stock, we need, how do you get average stock? Opening stock plus closing stock divided by 2. Opening stock given. Any average stock given. That means in this problem, average stock we can find or we cannot. If you cannot find average stock, what is the next best you'll use? So therefore, inventory turnover ratio ka formula is what? COGS divided by average stock or closing stock? Closing stock. And do you know COGS? How much? 18 lakh. So use this information. Inventory turnover ratio is 12 and COGS is given to be 18 lakh. You can use that and find closing stock. Inventory turnover ratio is 12. Inventory turnover ratio ka formula COGS divided by closing stock. COGS is given to be 18 lakh. Closing stock you don't know. is equal to 12. Therefore, closing stock how much? 1,50,000. Any problem? So closing stock we got it as 1.5 lakh. And now, so total current asset how much? 4 lakh. These two if you add, you are getting 3,50,000. Therefore, cash we have to calculate or balancing figure. How much? 50,000. That's all. Done now. Fixed asset I don't even have to bother. Total asset is how much? 21 lakh. In that total assets 21 lakh, if current asset total is 4 lakh, means fixed asset total has to be calculated or balancing figure. If you want each balancing figure also, you can put a working note. Like total asset is equal to fixed asset plus current asset. Total asset is 21 lakh. Current asset is 4 lakh. Therefore, FA is equal to 21 lakh minus 4 lakh, which is 17 lakh. Like that also you can do, or simply write balancing figure. Because these are lengthy problems. You will not be able to put every working note. Even if I say wants to take away 1 mark, let them take. Mother body, no, learn to donate. Let us not worry. Our point is to finish the question in time. 1 or 2 marks if you are losing for all this balancing figure, let them take, no problem. Everyone enjoy. We are not greedy. We are okay with 60, 65, no. 70, enough, no. More, 80, now okay, 80, 20 marks you donate, pa. Enough, no, they're saying 40 also enough, sir. Okay. Problem over, Aji. Hey, they asked operating expense, macha. You forgot about that, no? How to find? Tell me the equation again. Sales minus COGS is GP. GP minus operating expenses, EBIT. EBIT minus interest, blah, 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 blah. Now you will get operating expense. When you put up income statement, operating expense, you will get it as balancing figure. That's what we have done here. Check. Sales, so missing a given now. Sales given, COGS given. Sales minus COGS will give you GP. GP minus operating expense gives you EBIT. EBIT we don't know. But do you know net profit? Everyone check. Do you know net profit? How much is that? What does net profit mean? PAT. So PAT is 3,75,000. We got it. Now one information they told, tax rate is 50%. Sir, if tax rate is 50%, suppose profit before tax is 100. And if tax rate is 50%, what will be tax? If profit before tax is 100 and if tax is 50%, what will be tax amount? 100 ka 50%, which is how much? 50. Therefore, PAT also will be how much? So that means what is the conclusion I'm saying? If tax rate is 50%, these two amount will be different or same? If tax rate is 50%, these two amount are same. So if this is 375, tax also will be 375. Correct, Aji? Now, how do you get EBT then? Deducting these two or adding these two? Adding these two, you will get 3 lakh or rather 7.5 lakh. Interest missing a given. So that means how do you get EBIT? 750 plus 60, you will get 8 lakh 10. Now this you know 42 lakh, this you know 8 lakh 10. Operating expenses, balancing. That's what they asked. Getting it? Pakka na. Simply putting up an income statement, whatever data is there, update, you will get operating expense as balancing figure. But don't forget, tax rate is 50%, andre, these two value will be same. That is the clue. Once you have figured out this, all others will go on getting as balance. You can go on calculating and the problem should be over. Yes, Aji. Yes, Ji. Next one, Next one, Aji. Sir, how many more? I want to do 2 more. You tell me how many more you are ready to absorb. 2 more. Pakkana. Ready. Right. Fine, sir. Question. He is saying no, sir. I know. So from 12:30 you are looking at door now. So your feelings I can understand. So it is okay. I'll not even bother asking you. Yeah, no, I do understand. It is tough because you're sitting from morning 7. No, it's already been 2 o'clock. Papa. Yes, no, it's not easy at all. I do appreciate that you have come on time and you have stayed this long and trying to be as attentive as possible. That only I appreciate. I know it's very difficult. And that too, this is one-way traffic, no. At least normal class mein, at least we can aram se chit chat, we can do when you're bored, or we can tell some story, we can put some blade, something we can do and kind of bring your attention back. Here marathon means already time. Here also I can tell story, but I feel bad for the recorded guys. Because I know that they'll watch marathon and all on the examination day. Now if I start saying once upon in time in articleship, they will be like, hey, dabba fellow, finish and go da. This guy is looking at door from 12:30. They will be looking at door from starting only. So I don't want to stretch off my marathon. So only subject related content we will focus on here. Now from the correct macha. From the following information of Lakshmi Private Limited, you need to again prepare what? Summarized balance sheet. One good takeaway will come from this question. Because of that, this question is an LDR. Anyway, here no point in talking about LDR. Net working capital, how much? 480. Bank overdraft, 80. Bank overdraft is a current liability. Fixed asset, it's not proprietary ratio, it should be proprietary funds. Fixed asset divided by proprietary funds, if you do, you will get 0.75. We'll see. Reserves and surplus 320. Current ratio 2.5. Quick ratio 1.5. Now people in leverage, leverage there was a connection. What connection? Financial leverage and interest was a connection. Here also in ratio, two connections you will mostly see in exam question. One is net working capital and current ratio. If they give you these two, automatically you can start working note number 1. How? Sir, net working capital how much? 480. How do you get net working capital? Current asset minus current liability. And they have also given current ratio. How do you get current ratio? Current asset divided by current liability. First, check this. It's a pure substitute. What is current ratio? 2.5. So with this we can find current assets and current liability. Current ratio is given 2.5. Value they have not given. But we know current ratio is current asset divided by current liability. Therefore, when you cross multiply, can I say current asset is 2.5 times of current liability? Done now? Okay. They have given net working capital how much? 480. How do you get net working capital? Current asset minus current liability is 480. Now I will not write current assets. Current asset I will substitute with, how much is current asset? 2.5 times current liability. Instead of current asset, we will write 2.5 times current liability. Minus current liability is 480. Solve and you will get current liability 320. Therefore, what will be current assets? 2.5 times of this number, which will be 8 lakh. Hence, this is a good connection. What connection is this? Current ratio, net working capital. When they give you this, automatically you can find current assets and current liability. Done now? Now, if they give you current ratio and quick ratio, that is also a connection. What ratio? Current ratio and quick ratio. This is also a connection. Using this, you can find closing stock. How? Is quick ratio given to you in the problem? Check. Is quick ratio or liquidity ratio given to you in the problem? How much? 1.5. Quick ratio, what is the formula? Quick asset divided by current liability is 1.5. How do you get this quick assets? From current assets, you have to reduce closing stock. Prepaid expense will not be there, leave that out. From current asset, if you reduce closing stock, you will get quick assets. Divided by current liability is equal to 1.5. Correct? Current asset, you know. Current liability, you know. Quick ratio, you know. What is the only thing balancing figure? Closing stock. Solve and you will get closing stock as balancing figure. So hence these two are connection. The moment you find this, you don't have to even read the other things. Go ahead and update this. Fine, people. Now we'll figure out what are the other things to do it. Now at least whatever components we have got, we can fill it up. No, total current liability we got how much? 320. Go to the balance sheet and fill it up. This is 320 lakh. Inner column, outer column. Total current assets how much? 8 lakh. Inner or outer? Outer column 8 lakh. Done now. And then what did we get? Closing stock. How much closing stock? 3 lakh 20,000. 3 lakh 20 closing stock, outer column or inner column? Inner column. Done. So far this much data we have captured and updated. So let's come back to the problem. What else is given? Let's put a tick of whatever information. Where are you going to? What and all information we have used? First tick. Net working capital we used. Yeah. Current ratio we used. Yes. Quick ratio. Yeah. Now see, bank overdraft is given. Bank overdraft is part of current liability. Can we go ahead and finish? Update it off. So 80,000 bank overdraft in outer column or inner column? Usually they will not give any other information about current liability. Total is 320. In that bank overdraft is 80 means others will be 240. Calculated or balancing figure? Balancing figure. That is done. Okay. Next, this is also used. Next, what is the information we have not used? Reserves and surplus, fixed asset divided by proprietary funds. No problem. We'll try to use this. Give me an equation of this. Equation of this you give me. Fixed asset divided by proprietary fund is equal to 0.75. Therefore, what is fixed asset? Fixed asset divided by proprietary fund is 0.75. Therefore, fixed asset is 0.5 times proprietary fund. Do you agree with me? Now, people, everyone observe. How do you get proprietary funds? We have already discussed. Proprietary funds means owner's funds. Who is the owner? Only equity shareholder or also preference shareholder? So, tell me proprietary funds ka formula. Equity share capital plus reserves and surplus. This is for equity shareholder plus preference. This is one way. Clear? There is another way to calculate same proprietary fund. This is from the equity liability side. You can also calculate proprietary funds from the asset side. What is that? Is FA plus net working capital minus long-term debt. FA plus what? Net working capital minus long-term debt. This is another formula to calculate proprietary funds. If you don't believe me, check. I proved it to you. Let's take a simple balance sheet. I've assumed this number. All these numbers simply have random numbers I've assumed. Calculate proprietary funds for me here. Normal may calculate proprietary funds. How do you calculate proprietary fund? Equity share capital, reserves and surplus, preference share capital. How much? 15 lakh. Yes, sir. That is a normal way of calculating proprietary fund. How much you got? 15 lakh. One more formula just now I told. Tell me what is that? Fixed asset plus net working capital minus long-term debt. Fixed asset. Okay. How do you get net working capital? Current assets minus current liability minus long-term debt. Do that. 15 lakh plus, how do you get net working capital? Current assets minus current liability. Or maybe I'll just write it here. Fixed asset plus net working capital is current asset minus current liability minus long-term debt. 15 lakh, this will be what? 3.5, yeah? Minus 3.5, how much are you getting? 15 lakh. You got a different answer or same answer? Same answer. Proved. So we have to use this particular equation. Okay, rather this. Current asset minus current liability is what? Net working capital. So therefore, I'm using what equation to get proprietary fund? Fixed asset plus net working capital minus long-term debt. I proved it to you. Whether you do it normal way or this way, answer is same. Now, why am I using that? This equation is net working capital in this problem missing or given? Given. Proprietary fund and fixed asset, they've established some connection in this problem. Just now we read. Long-term debt not given, so it is 0. So we can solve this equation to get fixed asset and proprietary fund. If you want, just check. I'll maybe show you the solution. Fixed asset divided by proprietary fund is how much they told in the problem? 0.75. Therefore, fixed asset is what? 0.5 times proprietary fund. Now, they told, or rather, how do you get proprietary funds? Through another way, not the normal way, another way. Fixed asset plus net working capital minus long-term debt. Okay, proprietary funds, PF, I'll write it as it is. Instead of fixed asset, I will substitute. What is that? Instead of fixed asset, we will write 0.75 proprietary funds. Net working capital missing a given. Given how much? 480. Long-term debt not given 0. So solve this equation and you will get proprietary funds 19,20,000. Easy. If you know proprietary funds, you can find fixed asset. How much is that? 0.5 times proprietary fund. When you solve, you will get fixed asset 14,40,000. So don't forget this equation. Okay, now people. Whenever they say proprietary funds, two equations should come to your mind. What are those? Equity share capital, reserves and surplus, preference share capital. One way. Another one. Fixed asset plus net working capital minus long term. You check if they have given direct information, use direct equation. If they have given net working capital, use this particular equation. Fine, now people. Now what and all we got here? We got fixed asset. Proprietary fund is okay. Fixed asset, where it will come? Balance sheet. 14 lakh, how much? 40,000. Fixed asset, you know. Current asset total, you know. That means you also know. Total asset side. What did I say? The moment you write one side total, update the other side total also. Correct now. In this problem, long-term debt, preference share capital there or not there? Not there. Reserves and surplus there. Reserves and surplus there. Yeah, reserves and surplus is given how much? 3,20,000. Update reserves and surplus. How much? 3,20,000. This is given. That means equity share capital, either you can put up a working note or get it as a balancing. If you want to put it as working note, very simple. Okay, how do you get proprietary funds? Normal way for proprietary fund. Equity share capital, reserves and surplus, preference share capital. How much is proprietary funds ka total? 19,20,000. 19,20,000 is equal to equity share capital plus reserves and surplus given 320. Preference share capital not there, so 0. Solve and you will get equity share capital 16 lakh. Either like this or get directly as a balancing figure, your choice. Fine. So the takeaway of this question is proprietary funds. Another way to get proprietary funds. That's the takeaway, a good takeaway from this question. Done na people? Pakka na people? Why are you smiling people? Okay. Class over, huh? No, sir. Yo, class, if it was over means we'll be smiling big time, sir. And now, last one. Chudama. Ashte. Looks like whatever dialogues we give in class will come back to us one day, no? We should be a little careful what we use, huh? Yeah, we will use and we will forget. Later it will come back to us. Yeah, nice. Good that you guys remember. Thank you. Now people, next, question number 30, no? People, this question, no? I think I had one more to do, but I think I will just discuss this. You tell me this one. Operating ratio is 85%. What should click? Operating ratio means COGS plus operating expense put together is 85% of sales. Therefore, EBIT is 50% of sales. Clear? This is the takeaway of this question. And COGS and operating expense also they have linked. Using this, you can find out COGS and operating expense. Can you solve this question? Manageable? I plans to do this so you can manage this. Okay, fine. Or if you want, after this question, I'll ask once again. 5 more minutes if you are ready to spend, we will solve that question also. Otherwise, we will leave. Your call. Now, people. One more question. Mannan Limited ante. I think this is also a study material question. Lot of data given means, first, sir, when they give you percentage and all, ignore. Check which component they've given value. Any value? Net working capital. Waste. Because net working capital is current asset minus current liability. I want individual component value. Any individual fixed asset or good. Okay, 190. Then opening stock they have given. That means if opening stock is given, I can find average stock. That means inventory turnover ratio, I should not use closing stock. I should use average stock. That should click. Fine. So that means only information right now which is probably helpful to me is fixed asset. Okay, looks like I'm not able to proceed. Check is fixed asset linked with any component? Doesn't look like. Okay, now identify which component is linked multiple times. Total asset turnover, total asset. Yes. How do you get total assets? Fixed asset plus current. If I just find current asset, more or less I think problem is over. Okay, na sir. And now let's see. How can I find current asset, people? Go for your normal connection. One way an examiner will link is they will give net working capital and they will give current ratio. Given a current ratio, net working capital. Congratulations, you got current asset and current both. Once you know current asset, you already know fixed asset. So you can find total assets. And they have given return on total assets. So you can find PAT from this. Total asset turnover ratio, you can find sales from this. They have given GP. GP is 20% of sales, means COGS is 80% of sales. From COGS, you can use inventory turnover ratio and find average stock. Use that from opening stock and find closing stock. Problem over. That's all. That's a linkage. Okay, now. First, find always which value given. Not the ratio, You don't have to mug up all this. If you mug up, because next May they will substitute this with something else. So these are mathematics. You cannot mug up this. They'll keep substituting. So you can only establish a pattern. First, which value? Which value? And is that value linked with any ratio? Linked with any number? If that is not there, see if any number is linked multiple times. That will be the common clue. And then some common pointers. Common pointer is current ratio, working capital, they will link. Then they will give you current ratio, quick ratio. These are some common pointers. Think on those lines so you can solve these questions faster. That's the only way. Correct, people? And now, how do we proceed? Now you guide me. We have already discussed. Give me the guidance. First, to net working capital and current ratio we will link and find out what from this. Current assets and current liability. Should I have to take you through that or substitute, you know? So current liability you got 9 lakh. Current asset you got 22.5 lakh. Fixed asset is already given. Current asset you got it now. Using these two we can find total assets. Fixed asset given 30 lakh. Current asset 22.5. So total asset is 52.5 lakh. So far okay now. Now check total asset is linked with what and all. They gave return on total asset is 15%. Return on total assets. Now return on total assets, there are two formulas. One EBIT into 1 minus tax rate divided by total assets. Another one PAT divided by total asset. Both two formulas are there. I told depending on what you need to find in the information, use. Check the problem. They asked what? Last line check. EPS. For EPS, we need EBIT now or PAT is more suited. That means which formula we will use for return on assets? PAT. Correct? That means I will use PAT ka formula for return on assets. What is PAT ka formula? PAT divided by total assets. Is this missing or this is given in the question? Given as 15%. So use that. Return on total asset is 15%. PAT divided by total asset is 15%. Total asset we have. So from this we can solve and get PAT as how much? 7,87,500. Need a minute or okay? Done. So this is sorted. Next, what else they have linked with total assets? Total asset turnover ratio. How do you get total asset turnover ratio, people? Sales divided by total assets. Total assets, you know. Total asset turnover ratio is 2. So total assets, you know. This, you know. Sales, you don't know. Solve, we will get sales to be 105 lakhs. Done now. Now sales, they would have linked with GP, NP, COGS, whatever. Check what they've linked. They told what in the problem? GP is 20%. Sir, if GP is, when they give you 20%, it is always 20% of sales. If GP is 20% of sales, COGS will always be 80% of sales. I mean, moment you know sales, two things we can find, GP and COGS. Find that. GP is 20% of sales, COGS is 80% of sales. Sales ka 105 ka 80% is 84 lakhs. That is your COGS. Done. Now, what and all information we have used and what are yet to be used? Current ratio we used, yes. So then return on assets we used, yes. This one, yes. GP, yes. And what about stock turnover ratio? Used or not yet? This is your inventory turnover ratio. Let's use this. What's the formula? COGS divided by average stock if you can find. Otherwise, closing stock. But here opening stock is given, no? If opening stock is given, we can't find average stock or we can? We can. That means what is inventory turnover ratio ka formula in this problem? COGS divided by average stock is equal to how much? Inventory turnover ratio is given to be 7. COGS we just now solved 84 lakh. Using this you will find, get average stock. How much is average stock? 12 lakh. Any problem? What is a normal way to find average stock? Opening stock plus closing stock divided by 2. Average stock you know. Opening stock they only given in the question 11 lakh. 40,000. Closing stock you don't know. Solve this equation to get closing stock to be 1,60,000. Okay na Sarji? Any problem Sarji? Need a minute Sarji? No sir. Please leave sir. Okay. Okay. Stock turnover ratio is 7. Sorted. Net working capital. I think we already used this. Fixed asset. We already used this. Equity shares. So 1,80,000 equity shares of how much each? That means equity share capital, can I say is 18 lakh? Okay, we'll see. 60,000 preference shares of 10 each. That means preference share capital is 6 lakh. So in this problem, preference shares are there. Okay, these two we'll see what to do. First of all, what did they ask? Quick ratio. What is formula for quick ratio? Current asset minus closing stock divided by current liability. Current asset you know. Closing stock, you know. Current liability, you know. I mean, this one, any trick? Difficult or easy? Substitute, straightforward. Fixed asset turnover ratio. What's the formula? Sales by fixed asset. Sales you already found out. Fixed asset, they only given 30 lakh. That means this is also straightforward. Done now. Correct? So these two plain. I don't have to show you that. It's sorted. Proprietary ratio, people. Proprietary ratio, people. Come. Book much, huh? You take what and all you need. I will give you everything. You got iPad, proprietary ratio. How do you get proprietary ratio? Proprietary funds are divided by total assets. And how do you get proprietary funds? Equity share capital plus reserves and surplus plus preferential capital. Sir, given no, sir. Add, sir. Hey, don't add. Reserves and surplus given are missing. Sir, assume 0, sir. We can assume 0. But hang on. Check, have you used all the information in the question? Second line, what they told? Did we touch that? Did not even read. Okay. Debt equity ratio. Let's see if we can do something with this. Tell me the equation format of this. Debt divided by equity is equal to 1 divided by 1.5. Correct? Okay. Equity ka value, you know. Sir, equity means equity share capital and reserves and surplus. You know equity share capital, reserves and surplus, you know or you don't know. So let's at least try to substitute. They gave debt equity ratio as 1 divided by 1.5. When you solve, what you're going to get? Equity will get multiplied here, debt will get multiplied here. So equity is what? 1.5 times of debt. Correct, Aji? Okay. Now, did it land us anywhere or still stuck? Because we don't know reserves and surplus. Correct? We still don't know. Now, whenever you are getting stuck after reading all information, if you are not able to proceed at all, means one God equation is there. God level equation. Remember that. Balance sheet. Total asset will always be equal to total equity plus liability. If nothing is clicking, that will click. Pakka. Okay. God level equation. It will always click. What is that again? No? Total asset is equal to equity plus liabilities. Yes, sir. Total asset may we need fixed asset, current asset. Do you know? Yeah. How much? 52 lakh 50,000. Equity, people. Equity means equity share capital and reserves and surplus. But for the time being, we have a linkage between equity and debt. So I will not write equity and reserve, equity share capital, reserves and surplus. I will keep it as what? Equity. I'll keep it as equity. So that means tell me what and all components can come on the liability side. Equity share capital, reserves and surplus. These two put together becomes equity plus preference share capital plus long-term debt plus current liability. Now instead of equity, I will substitute. What is that? 1.5 times debt. Because that's the reason they gave you this equation. Equity is 1.5 times of debt. Debt we don't know. I'll keep it as it is. Preference share capital missing or 6 lakh? 6 lakh. Current liability we already got. How much we got current liability as? 9 lakh. So that we have got. Everything we have now. You just have to solve this equation to get the debt. How much is the debt value? 15 lakh. Any problem, people? Just give you a minute to observe this. This is just balance sheet equation. Total asset is equal to total equity plus liability. Don't write equity share capital plus reserves and surplus. Why? There is a linkage between equity and debt. Equity refers to equity share capital and reserves and surplus. We want to use this link. So hence, instead of equity share capital and reserves and surplus, we have written equity. Because we can substitute this on what terms? On debt terms. So when you solve, we'll get as debt as 15 lakh. If debt is 15 lakh, what will be equity? 1.5 times of debt. Do 15 lakh ka 1.5 times? 22.5. Done now. And how do you get equity? How do you get equity? Equity is net worth. How do you get that? Equity share capital plus reserves and surplus or retained earnings. Equity is 22.5. Equity share capital was missing or given? Given. We have already told now in the question only. How many shares we have? 1,80,000 shares of 10 each. Therefore, equity share capital how much? 18 lakh. So equity is 18 lakh. That means when you solve, you'll get retained earnings 4.5 lakh. Yes, sir, people. Therefore, you can't assume reserves in surplus 0 because we do have value. Okay. That's all. Clear? No. Now, you know equity, equity share capital, retained earnings, preference share capital also. Can't you find proprietary funds? How do you get proprietary ratio? Equity share capital, reserves in surplus plus preference share capital divided by total assets. All these three components you have found out. So, proprietary ratio will be straightforward. Last one, EPS. How do you find EPS? E is divided by number of equity shares. Now, you already know PAT. How much is PAT? You already solved. PAT is how much, people? 7,87,500. So, there is no preference dividend. PAT is same as each, sir. Preference share capital is there, macha. Here, how much? 6 lakh. They gave in the question. What percentage preference shares? 9% preference shares. Preference share capital is 6 lakh. So, preference dividend not there or there? 6 lakh ka 9%. How much? So, to get each, what do we do? From PAT, we have to reduce preference dividend. PAT, we have already got it here, 7,87,500. From that, reduce preference dividend. And number of equity shares, they only told 180. Solve and you'll get the EPS. That way, good question. Okay. So, what is the takeaway of this question? One, no, if you are full stuck, everything you have used, if you are still stuck, means balance sheet equation. Another point you can add. So far, what are the common pointers we have found out? One common linkage is net working capital, current assets. Second one is current ratio and quick ratio. That is one. Then proprietary funds ka one normal way is equity share capital plus reserves in surplus and preference share capital. Another way, fixed asset plus net working capital minus long-term debt. Okay. Write the current assets on the outer column, total components in the inner column. And when you know one side of the total balance sheet, fill up the other side also. And check which component is linked multiple times. Nothing is working, God level equation. Somewhere in this, you'll be able to figure out the answer. Okay, now, I don't think so. Still, you'll be stuck there. Somewhere around this, you'll be able to solve. I think these are good common pointers for ratio. Now, last question. What do you want to do? Do or skip? Do means 10 to 15 minutes. Skip means skip. May 24 wala question. Your call. Do me quickly, majority opinion. Election time, I'll take majority. Do. Okay, do. It's not democracy, sorry, macha. Lastly, I checked it was that only, no? I don't know, we're in North Korea now. Okay, theme limited guess given following information, no? 12.5% debt. 12.5% debt. When they give you percentage, always what should click? Interest. Debt value is given how much? 45 lakh. Therefore, how much will be interest? 45 lakh ka 12.5%. Interest is 5 lakh 60 to 500. Somewhere we may have to use this. Let it be. Now, people, debt you already know. They've linked debt with equity. That means if you know debt and if you know debt equity ratio, using this, what we can find? Equity. Let's find this. We'll go there only. So, if you do, first of all, what did they ask in the question? And you need to calculate few things. Interest coverage ratio they have asked. For that, we need interest and EBIT. They have asked gross profit ratio. We need for that GP and sales. Then they have asked current assets. Since they are asking multiple components of income statement, let me have the income statement and then we'll figure out the other things. Okay. Now, debt you know. Debt divided by equity, if you do 1.5 is to 1. Solve this equation. You will get equity. Where is it? Where it went? Here. Debt divided by equity is 1.5 is to 1. Debt is given to be 45 lakh. 45 lakh divided by equity is 1.5. Therefore, equity is how much? 30 lakh. So, first equation, I think we have used this. Yes, no? Let's put up, take this used. Next, return on shareholders' funds. You can call it as return on equity. You can call it as return on net worth, or you can call it as return on shareholders' funds, one and the same. How do you find return on equity? Ish divided by equity. Equity you already know. Return on net worth also you already know how much? 54%. That means with this you can find what? Ish. if there is no preference dividend, PAT to issue, both will be same. Okay, now. So let's use this equation. Return on equity is 54%. Return on equity is 54%, means the formula for return on equity is ish. If you quickly want, you can just check. Is there any preference share capital in the problem? Check. If there is no reference given to preference dividend or preference share capital, that means preference share capital is 0. If preference share capital is not there, preference dividend also is not there. So that means PAT and ish will be same. So that means return on equity, either you can write ish divided by equity, or in this problem you can write PAT by equity, because both will be what? Same. So now this we don't know. Equity we found out. How much is it? 30 lakh. This return on equity, they only told 54% or 0.54. So when you solve, you will get PAT to be 16,20,000. Done now. Income statement format, tell me. Sales minus COGS, GP. GP minus operating expense, EBIT. EBIT minus interest, EBT. Less tax, you will get E80. Now you already got PAT. How much is that? 16,20,000. Update that. 16,20,000. Got it? Okay. Now people, I'll be very happy if tax rate is 50%. If tax rate is 50%, this number will be same. Is it? Oh, Jai Allah, Jesus, Shiva. Ayyo. Ooh, disappointment. It is 25%. Okay, no problem. We'll come to that. At least we will see anything else we can use. Operating ratio, how much? 85%. Sir, if operating ratio is 85%, means EBIT will be 15%. Now what? Sales. If you know EBIT, we can find sales. If you know sales, we can find EBIT. One of the things we can find out. Then operating expense and COGSO, they have linked. Okay, they have some linkage. Tax rate 25%. Fixed asset 39 lakh. Current ratio 1.8:1. No. Current asset we know. No. Current liability do we know? No. Net working capital given? No. Okay, that means invariably I'll have to end up using this only. Tax rate is how much? 25%. What is that? Simple. Oh? Sir, if earnings before tax is 100, EBT is 100, what will be the tax? Tax will be, tax rate here is 25%. No? So 100 ka 25%. How much? 25. So therefore earnings after tax will be 75. Any problem? Okay, now check. I'll express this in equation. EAT, EBT. EAT, EBT. If earnings after tax is 75, earnings before tax will be 100. Agreed? Now in this problem, earnings after tax is missing or we have found? What is earnings after tax or PAT we have found? 16,20,000. If this one, if earnings after tax is 16,20,000, how much is earnings before tax? That wala proportion. Okay, now how much is this? 16,20,000 represents 75%. Or if you don't even have to do all this. 16,20,000, 25,000 is after tax. No, after tax, how much tax are you paying? 25%. That means 16,20,000 represents 75%. We want earnings before tax. Earnings before tax represents what percentage? Per 100%, how much? So into 100 by 75, how much? 21,60,000. That is your earnings before tax. Done, Aji. This you know means what is the tax amount? Either you can calculate 21,60,000 ka 25%, or you can do these two ka minus, your choice. How much is that? 5,40,000. We filled out interest we need. Always no people, income statement. No, don't keep it like that. First fill out all the data. Okay. First you write from sales till PAT. First you write the format. Have one working column here only. If it is simple working, we'll do it here only, like the way we used to do it for leverage. If it's a bigger one, we'll put a separate working note. Now, when you have already the format, you'll know, you'll accordingly go on filling. I think they had given debt. Debt is how much? 45 lakh. What is the interest rate? So interest is missing or interest is 560 to 500. So go ahead and fill up the interest. How much is that? 5,60 to 500. EBT is 21,60,000. Interest is 560 to 500. Means what is EBIT? These two ka addition, which is 27,22,500. Congratulations, you know sales. How? You know sales. How? They gave a ratio. What is that ratio? They told operating ratio is 85%. If operating ratio is 85% means EBIT will be 15% of sales. You know EBIT? That means you can find what? Sales. That is the next equation. Next working note, sales. Operating ratio is 85% of sale. Therefore, EBIT will be 15% of sales. So, EBIT is basically 0.15 of sales. EBIT just now we found out. How much is EBIT? 27 lakh 22 500. Therefore, sales will be, these took a division, which will be 1 crore 81 lakh 50,000. Go ahead and fill it up. This also got it. Okay, na Sarji. And now check what else information they have given which we can use. Did we use this particular information? The operating ratio we used. I think they have linked COGS with operating expense. Tell me what is the ratio equation format may express this? This one. Operating expense divided by COGS is equal to 2:6. That's what they have told. Okay, let's substitute, see what we'll get. Operating expense divided by COGS, you will get 2:6. Operating expense, you know, not yet. COGS, you know, or not yet? Not yet. At least let's do cross multiplication and see what we'll get. 6 will be multiplied here, 2 will be multiplied there. So 6 times operating expense is equal to 2 times COGS. So therefore, what people? COGS will be 6 divided by 2. What is that? COGS will be 3 times of operating expense. Any doubt in this so far? No. You can use one more equation. Once we have used, we can use it one more. Can you tell me what is that? Operating ratio was how much? 85% of sales. Because operating ratio was 85% of sales, we told EBIT is 15% of sales. Operating ratio means what all put together? COGS plus operating expense put together is 85% of sales. Correct? Operating ratio means COGS plus operating expense is 85% of sales. We'll use that equation once more. COGS plus operating expense is 85% of sales. Instead of COGS, we'll substitute. What is that? 3 times operating expense. Operating expense, I'll keep it as it is. Sales, you already know. Sales ka 85% will be this number. So now when you substitute, you will get 4 times operating expenses this number. Therefore, operating expenses that number. Give you a minute, observe. This is also one hidden adjustment. We have to use it properly. Okay, na sir? Sir, if you know operating expense, you know COGS also, because COGS is how much? 3 times operating expense. So multiply by 3, you will get COGS. COGS, you know, operating expense, you know, go ahead and fill it out. COGS, we got it. Operating expense, you got it. Sales minus COGS is GP. That means anything number pending or all ticked. All ticked. Now the requirement. What did they ask? Chiller pillar thinks so. Interest coverage ratio. How do you get interest coverage ratio? EBIT divided by interest. EBIT divided by interest. These two you divide quickly. Or leave. Number is 4.84. Anyway, all the data we got. Next, they asked GP ratio. Faltu. GP by sales into 100. Next, what they asked? Next to people, they asked current assets. Current assets. Oh, current ratio they gave, but net working capital not given. How can I find current ratio? When you are fully stuck, I told what? God level equation. God level? Tell God level equation. Total assets will be equal to total equity plus total liability. Total assets mein what is the breakup? Fixed asset plus current asset. Wait. Current ratio is given, no? Used or not yet? Let's use it. Current ratio is current asset divided by current liability is 1.8. Therefore, can I say current asset is equal to 1.8 times of current liability? Yes, sir. And now tell me God level equation. Total asset is equal to total equity plus liability. Breakup you give me. Instead of total asset, we'll write fixed asset plus current asset. Breakup there is equity plus debt plus preference share capital plus current liability. Fixed asset given. Instead of current asset, I will write 1.8 times current liability. Equity we already know. Equity and debt, they are only linked. We have already got it here. Equity is 30 lakh, debt is 45 lakh. Given. So equity, debt to given, no, added up. Preference share capital, any reference or no reference? Current liability, I'll keep it as it is. Because current asset, now I've expressed in current asset format or current liability. Now this is, solve this equation and you will get current liability how much. Understood? If you have current liability 45 lakh, what will be current asset? 1.8 times 45 lakh ka 1.8 times 81 lakh. Done na ji? Pakka na ji? Okay, I think these are good enough. 1 minute, I had written some common pointers in class and just show it to you. It might help you. This one, I think this you're comfortable. Write current assets, current liability in the inner column. Accounts receivable means debtor and bill receivable put together. What is one more way to find proprietary funds? Fixed asset plus net working capital minus debt. I've just given question reference where and all we have used that. That's okay. These are question numbers from our class notes. One more question is, people, they will give you 2 years ka data. They will give you 2 years ka data. In that 2 years, you will see, let's say, they will give you opening balance of retained earnings. First, they will give you 2 years data, okay? First year ka closing balance will become second year ka opening. In second year ka data will be closing balance. So basically, they will give you retained earnings ka opening balance and closing balance. By looking at this, what can you make out? Can you tell me? 15 lakh has become 20 lakh. That means 5 lakh is a profit earned in the current year. So if they give you retained earnings for 2 years, you can find PAT. For which year? Current year. So what is the difference between these two? 5 lakh. That is nothing but your PAT for the current year. It's actually not PAT, it is retained earnings. But in this problem, in such problem, equity dividend, preference dividend and all will not be there. So hence, by comparing these two, automatically you will get what? Profit after tax. That's another adjustment. And you already know God level equation. And operating ratio 85% of sales means EBIT will be 15% of sales. So, and the connection, net working capital and current ratio is one connection. Current ratio and quick ratio is another connection. So these are some common pointers we have used in class. You're taking picture, cheers. Take. Visible, till here done, Okay. Okay, now what? This is okay now. Sorted? Yes, I think with this, we can say ratio is completed. Thank you for your time and patience.